the Fed has no intention right now of pivoting. They have a complete understanding that they're about to cause households pain. And unfortunately, while they think that they can cause some pain without going into a recession, much less a deep recession, is kind of bold, but that's their view, that they think they can control this. Unfortunately, history suggests that's, quite a different outcome historically.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back for another weekly market recap with my good friend Lance Roberts. Hi, Lance. How you doing, buddy?
It's Friday. Glad to be here.
Yeah. Well, so we weren't here last week, at least not in this capacity, because we ran a retirement planning webinar that we had been talking with this audience about for months, and we finally made good on that promise. And first off, Lance, I just wanted to thank the guys on your team, Rich and Danny. They did a wonderful job. Really, sort of from all counts, the feedback we received was just incredibly positive on the detail and the conscientiousness those guys showed during the live Q&A. So thanks for those guys doing that. I thought it was a great presentation. A lot of interest for us to do more of these on other topics. I know estate planning came in there, a few other things. Right. So as long as you and the guys are up for it, we'll do more of this.
Sure, absolutely. Anytime. We love what we do, so always happy to share it with people who want to hear it.
All right, great. And folks watching, what we do here with Wealthion is we try to give you guys insights that are valuable, but most importantly, that are also actionable. And a lot of the data that was in that webinar really tells you sort of how to put all these retirement planning strategies into action. So if you didn't watch the video, just go to wealthion.com/retirement planning. And you'll be able to watch the replay right there yourself. And for folks that did watch it and would like to see us address other topics in the future, just do us a favor, let us know in the comments section what topics would be of greatest interest to you, and we'll prioritize those most. We had a lot of folks that had heartburn last week, Lance, because of Jackson Hole.
Right.
Powell basically dropped the hammer on Friday, and folks were really hoping, for one of these weekly market recaps the next day to make sense of it for folks. We couldn't do that because of the webinar, so we can do that now. So why don't we start with your key takeaways from Jackson Hole, because it certainly seemed to wake the markets up to the fact that, hey, it was calling Jerome Powell's bluff, but maybe that was a losing strategy.
And it was interesting because there was so much going on last Friday. As we were doing that webinar, I was like, there's so many things I want to say, but yeah, so the markets had been rallying, for the last 9 weeks, and we talked about that, here on the show. Let's go back a little bit in history for a second. Back to June, July, markets are hitting lows, and everybody's super bearish, right? The American Association of Individual Investors record bearishness. Just everywhere you looked, everybody was super bearish about the markets. Everybody said, we're going to crash. It's all coming to an end. And we were talking about then that what we had so much bearishness is it was bullish because it's almost contrarian in nature. And that was really setting us up for a rally to a degree. And we said here on one of our shows about 3 or 4 weeks ago, I said, what we really need is Jim Cramer to come out and say, the bottom is in, the bull market's back. And he did that, right? And so we had this really great 17% rally in the S&P. Ran right into the 200-day moving average, failed there. Markets kind of started just kind of drifting a little bit lower, nothing of consequence. And again, to your point, the markets were all betting on this pivot, right? The whole rally from the June lows were all based on this idea the Fed was going to pivot because inflation had printed zero for the month of July, and that was kind of that first shot across the bow. The Fed would definitely pivot here, and the markets were rallying on this hope that we were going to stop hiking rates and go back to QE. And on Friday morning, Jerome Powell came out and delivered this. It was one of his shorter speeches, by the way. It was a very short speech for one of these summits, but there was one key paragraph I'm going to read to you here. That was really the takeaway from this whole thing. He says, restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Now, that's a key statement because as you and I have talked about, this whole inflation problem that we have right now is because of the massive amounts of liquidity that were injected into the economy. You know, 2 rounds of $1,400 checks, another round of $900 checks, and the economy was shut down. So there was no supply to be had. And everybody was going out to rebuild patios and buy pools and cars and houses and everything else. And so when you had this lack of supply, all this liquidity and the surge in demand, voila, you get inflation. So what he's talking about here is using these tools forcefully, that's hiking rates and reducing their balance sheet, to bring supply and demand back in balance. How do we do that? Well, we do that by slowing economic growth, which comes to his next sentence. Reducing inflation, this is Jerome Powell, is likely to require a sustained period of below trend growth. Now, this is an optimistic statement because he's saying below trend. Trend is about 2% growth in the economy. So below trend is somewhere between 0 and 2. And the problem is that once you get to below 2% growth, it's very easy to slip into a recession. Now, the Fed's hoping that they can avoid a recession, that they can hike rates and slow the economy, bring down inflation by killing demand, and not throw the economy into a recession. I think that's a pretty tall order, but let me continue with what he states. He says, moreover, there will likely be some softening of labor market conditions. And while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation, but a failure to restore price stability would mean far greater pain. And so what that statement really said is that the Fed has no intention right now of pivoting. They have a complete understanding that they're about to cause households pain. And unfortunately, while they think that they can cause some pain without going into a recession, much less a deep recession, you know, is kind of bold, but that's their view, that they think they can control this. Unfortunately, history is you know, suggests that's, you know, quite a different outcome historically.
Yeah, I thought it was very surprising. I'm glad he did it, but I thought it was very surprising that Jerome Powell used the word pain. To me, I was sort of referring to that as his Mr. T moment. I don't know if you remember Rocky III, but he's got that great quote, "My prediction, pain." Right. But as you and I have railed for many times in this program, we sort of have a cadre of leaders that you know, they're perennial chronic can kickers, right? And we wanted somebody who had sort of the courage and the boldness to say, hey, look, guys, you know, if we want a better tomorrow, we got to take our lumps today for it, right? And look, you know, I'm not absolving the Fed here. They're the biggest culprit, you know, of the bunch in my eyes. But you know, I do have to hand it to Powell to, you know, to give America, or, you know, the markets a bit of the tough love that they need here. And I think it did catch the markets by surprise, and pretty much, you know, starting from that announcement through, I haven't looked at the markets today, but like pretty much every day has been, you know, lower, as it's been, you know, the realization's been sinking in on markets that, okay, we were all positioned for this pivot, and man, it really does not look like it's going to happen anytime soon. It's funny how you're talking about, you know, what Powell is saying is look, we want to go under trend for a while, and we're going to, you know, sort of finesse this softish landing here as we can. And you and I know from the Fed's history, they have about zero successful you know, times in the past doing anything this graceful. So you know, I think Powell talking about pain in some ways is still coded for, hey, there's probably gonna be a lot of pain, folks. So this is me telling you all to get ready for this, right? To gird yourself for what's coming. And so anyways, the market euphoria has been popped here. I guess the question is, you know, where does it go from here? Is this what's needed to resume if we're indeed in a bear market here? Or I know you've said we're not in a true bear market because we haven't broken through the long-term bull channel trend yet. But could this be the trigger that brings markets substantially lower for the second half of the year? Because they're, as you said last time in this program, there's really no fundamental bull case to be made right now. You know, it was technical because the markets were, you know, rising closer and closer to these key levels. But now that they're not anymore, and they've had this disappointment from the Fed, is there any really credible reason to expect a bullish resumption here anytime soon?
Well, the thing is that you never know what is going to drive markets. Again, when we were sitting here talking in July, it was like, oh my gosh, what could cause this market to rally here? And right, we were talking about the fact that you just had so much bearishness that you have these setups for a fairly strong, kind of bullish rally. And so, look, there's a really easy bear case to make right now, which is that the Fed's hiking rates. We're now at $95 billion a month in quantitative tightening.
Right.
So look, what's the Fed wanting to do here, right? So the Fed's wanting to slow economic growth. They're wanting to kill inflation. We do that by slowing economic demand. And so if we slow economic demand is where corporate earnings and corporate profits come from, because, we go out into the economy, we buy stuff. That's what creates the revenues for corporations. So if we slow down our consumption, which is 70% of the economy, then by kind of de facto nature of how things work, corporate earnings are going to decline. And corporate earnings now are still, extremely elevated going into 2023. And those have not come down to a reality of where we are. I mean, right now, there is no expectation really of a earnings recession in 2023. But if you're going to have below trend economic growth, you're going to have below trend earnings growth, and stocks aren't priced for that yet. So again, we can make a really good bearish case for sitting going, hey man, you just go sit in cash for a while because there's not, but the problem with that is that a number of things can and could happen, right? Which is, tomorrow we wake up and Russia-Ukraine is resolved, right? There's a peace treaty, and the Iran nuclear deal gets worked out, and we have a resumption of oil supply deliveries, and oil prices come down, relieving impacts on consumers, and all of a sudden you've got this kind of bullish case getting formed very quickly, and that's where markets are going to start to anticipate a recovery in the economy. And then of course, if the Fed comes out and does pivot at any point, that's all really everybody's not really looking at fundamentals. Everybody's just watching the Fed now. And so
right.
When's the Fed going to pivot? So, if the Fed comes out in the next, month or two and says, okay, we're done. We've done all we need to do. This market's going to take off running. So, my point about this is that as we've said here on the show before, it's ridiculous to try to predict markets more than about 3 days out. On Monday and Tuesday, I was writing in our daily commentary that we publish at our website that you subscribe to for free. We deliver it to you before the market, but we've been writing every day this week, hey, this market's really oversold. We're going to get a rally. Well, that was on Monday. We didn't get a rally, on Wednesday. So, 3-day prediction, it didn't work out. We got a rally on Friday. So, this is, that's the problem with markets. They can do things that you don't expect them to do. And this is why making big bets in one direction or another, typically never work out well.
Right. And sorry to interrupt. Just want to underscore something you've said many times, which is, don't be completely one-sided in your strategy.
Yeah. But again, look, we're, in our portfolios right now, we're still, 35% equities. We're, almost 40% cash. We're underweight our fixed income index. So we're conservatively positioned, right? We're certainly not positioned for a bull market. We're positioned more for a bigger correction in the markets, and because of this failure, and now we know for sure, a lot of debate on the rally from July into August. Was that the resumption of the bull, or was it a bear market rally? Well, now we know it's a bear market rally, and so that means that we're still in a technical bearish market. And, rallies need to be sold into. So as, if we're going to get this rally on Friday, markets were oversold. The employment number was kind of Goldilocks this year. It wasn't too hot. It wasn't too cold. It wasn't anything that's going to make the Fed more aggressive, but it wasn't bad enough to make the Fed back off. So markets kind of like that because markets were really oversold and they needed something to kind of, provide a catalyst to put some money back to work. But again, this rally, we're below the 50-day moving average. That's now the new resistance. We've got to get above that 50-day moving average if we're going to retest, the previous highs from last week. But that's the real risk here. So any rallies back to that resistance at the 50-day that fails, we need to take some money off the table. We play this market right now from a bearish side because that's what it is.
Yeah. So a couple things I want to mention there. First off is I remember seeing some comments come through last week, I think, in the comments under our last video. And there were one or two folks saying, hey, Lance had been saying sell into this rally and the markets just kept going higher here, right? And, you turned out to be, I just want to pat you on the back, as we were rallying through July and into August, you were basically saying, hey, we're still using this as an opportunity to take gains off the table because we don't trust this, right? And as you're saying, it's looking like that was the wise call, right? But it was funny, because not funny, but we were seeing examples near the end there of that emotion that people have, typically near tops and bottoms, where the emotion takes over and they say, I was being disciplined, but I now want to throw caution to the wind because I'm now convinced the market's either running higher or running lower here, right? And usually that's when people make the absolute wrong decision at the wrong time. And this is why we keep hammering on this channel to work with an advisor and build a plan and stick to it, as long as the core tenets of your thesis don't change, because your emotions can really tug at you and whipsaw you like that.
Yeah, listen, trust me, Michael Leibowitz and I, we have these conversations, every day in our morning. We have our investment committee meeting. And, we have the same debate. And right here at the end of that rally, as we were heading up to that 200-day moving average, trust me, we're sitting there going, is this time really different? We're starting to do some pretty bullish stuff here, where we've had a 50% retracement that normally you don't have, and this market's kind of putting some bullish trends together here in terms of pricing. And so we were questioning our own strategy, right? It's like, do we need to get more aggressive? And that's the challenge. We're watching our signals, and our signals were starting to turn negative, and that was telling us right around that 200-day moving average that we needed to be a bit more cautious, raise a little bit of cash, kind of rebalance portfolios a little bit. And now we've got a very good MACD sell signal in place, and that's just telling us right now that this sell-off has got downward pressure in it. So we want to remain a lot more cautious until we get that next buy signal.
All right. And just two things about caution. So two interviews I've done recently. I interviewed a fellow Texan last week, Kyle Bass. Phenomenal interview, folks. If you haven't seen that yet, I'll put up a link to it right here. It was a great coup to get him for the channel. And he was almost as good as Lance Roberts, if you can believe that.
Yeah. Okay. That's hard.
But he on quantitative tightening, he and I talked about that, and in his opinion, he thinks that's going to be much more impactful on the economy than the rate hikes to date have been. So he's basically saying, look, Fed's out there trying to slow down demand. We're beginning to see the initial aspects of that, but he said, I don't think you've seen anything yet until we have a couple months, a quarter or two of QT, and that's when you're really going to see the slowdown hit hard. That is to remind folks, that's just beginning to start now at scale.
Yeah, and that's the big and look, that's something even that the Fed acknowledged in their Powell's Jackson Hole Summit speech. He acknowledged that monetary policy has a lag effect to it. So here's the problem, and this is, and as we were talking about for the Fed, you have a very poor track record of successfully navigating, these tightening periods and not throwing the economy into a recession, if not some type of financial crisis. And the reason is that the Fed is looking, and we talked about this, I think, week before last, that the Fed looks at this lagging data. And so they're looking at employment, they're looking at jobless claims, they're looking at stuff that happened over the last month or last quarter, and they're going, okay, well, the economy's pretty strong here, so we can keep hiking rates. And this is like driving a car using the rearview mirror, and a lot of kind of reasons is that they're driving down this freeway, looking in the rearview mirror, saying, yeah, road's pretty straight, and so they're driving, and at the same time, they're doing these policy changes that don't impact the economy and the markets for about 9 to 12 months. So the problem is by the time they've passed the curve, in the economy, they're out clear way over the ledge at this point. The car started to careen down the cliff, and then they go, oh, well, maybe we tightened too much. And seeing the risk here is that you're doing this quantitative tightening, which is extracting liquidity out of the financial system, primarily the banks, and then you're hiking rates, which is extracting liquidity out of the consumer. So what you don't know, and we can have this debate all day long, Adam, what level on Fed funds rate snaps the camel's back, right?
Right.
And you tell me it's 4, and I say, well, I think it's 3.5, and we can run some math and we can kind of figure out an optimal rate that says, okay, at this point, everybody just kind of puts the brakes on. Well, the problem is they're going to go 3, 3.5, 4, 4.5, and the rate that broke something in the economy was actually 3.5, but now they're at 4.5, and by the time that 3.5% hits the market, it's 9 months later, and they're still hiking rates, and then they go, oh crap, something broke. And that's going to show up in the credit market somewhere, whether it's the bond market, the credit market, the housing market, something. It'll be something credit related. But my point is there's a point in monetary tightening that breaks the economy, and the problem is they won't see it until after the fact, and that's why the risk of a monetary policy incident is really, really high right now.
Is so high. Yeah, exactly. Yeah. In the fact that even if the Fed then pauses or pivots once it realizes it's gone too far, it could still be too late, but it could still be quarters before you see any relief from the efforts that they start, doing at that point in time, right? And I've used that example of kind of the waterboarding, forcing you to drink a gallon of water either over a week or over a minute. I got a different analogy, and let's see if this murders things completely. But it's sort of like, as you said, the Fed is sort of, they're looking in the rearview mirror, they're looking at historic data. And they may be saying, hey, Lance is walking too fast. So we're going to take, here, buddy, you go find Lance, put this 25-pound weight on his back. And, that's going to start slowing him a little bit. And so they're there every month saying, okay, well, we need to make another, rate hike. That's another 25-pound plate or whatever plate, go give that to Lance. And so as you're walking, you get a plate on your back, you slow a little bit. Another guy shows up to you, puts another plate in your back, you slow a little bit even further. At some point, you get to the part where you can't stand anymore and you sort of, you fall down to one knee because you got so much weight. Well, there's still like 8 guys walking to you with plates, and they keep loading those plates on you, right? So even though you've stopped now, they're just crushing you under more and more weight. And if the Fed says, oh my God, well, we put too many plates on Lance, they send a guy to take a few off, they send a guy to take a few more, and it takes a long while before you're actually back up and walking again. And I think that's the danger here with the economy. As you said, it's almost a certainty, I think at this point, we can predict the Fed's going to make that guy, it's going to squish him. And when they decide it's time to pivot, it's going to be a while before he's actually back up and walking again. And that's the danger we have here. Hopefully that analogy made sense to folks.
Oh, no, it makes great sense to me because apparently you've been on one of my Saturday ruck runs. So,
Not yet, but it'd be fun to actually do that sometime.
Yeah. No, they're not fun at all.
All right. Well, look, so the other interview that I just wanted to mention real quickly was one I just recorded the other day with Sven Henrik, technical analyst. That's his world, right? He just lives the tape. And he says pretty much what we just saw was classic bear market action, where you see, a fairly material decline in markets. You then see a pretty sharp, fairly strong rally that gets right up to those key resistant levels. The ones that he looked at are the 200 DMA, which you mentioned earlier, and the 50 weekly moving average. And he said, we tapped those. We even had a little poke over, but then it was rejected and started to head down. He said that's classic what you see in a bear market. And generally, once you have that failed test, what's likely is you hit the lows again, or you make new lows. And so, like he's saying, look, nobody's guaranteed what's going to happen, but if we sort of look at historical precedent here, that seems to be what's more likely to happen than not going forward. So, we'll all be watching the tape real closely on that.
Yeah, and that's going to be a really interesting thing here, because on that July to August rally, we retrace 50% of the decline from the all-time highs. And there was just a slew of data that was put out. Articles were coming out everywhere from Bank of America to Goldman Sachs to every analyst on television. Like, there's never been a point in history where we retraced 50% of the previous market decline and then went back to new lows. So this is going to be an interesting challenge here to see if we go back to new lows. This will be the first time going back to like 1950 that we've done this 50% retracement. I want to put a caveat on this real quick. In the 1960s and 70s, actually from 1960 through 1974 to be exact, most people remember the 1974 bear market, right? We talk about, oh, the bear market of 1974 is the black bear. At the bottom of the 74 bear market, barons came out, our equity's dead. That was the bottom of the market. Well, what most people don't realize is that there were 3 bear markets back to back going through the 60s and up to 1974. And markets had rallied all-time highs in the early 60s. They sold off, had a bear market, and then they rallied back to an all-time high. And everybody's like, "Ooh, wait, we're all back to an all-time high. It's great." And then they went to new lows, and then it rallied back to new highs again in 1973. And then the bottom fell out in 1974. But it was this rolling series of bear markets that were being caused by, guess what? Inflation, the Fed hiking rates, combating inflation. We'd have a bear market, inflation would come down, we'd have a recession, then the Fed would drop rates, the markets would rally again. And that was that whole process through 1974. And then, of course, in the late 70s, early 80s, we're combating, inflation with Paul Volcker. But the point is during those periods, you had these sell-off declines, you had the 50% retracements that went to new highs. Everybody was like, "Oh, this is awesome." And then the bottom fell out of the market again, and you went to another set of lows. So you got to be really careful. My point here is you got to be really careful with all this analysis you see on television, because what they do is they go, "There's never been a point in history where this has occurred, and over the next 12 months you had positive returns." The risk to that is that you've got to look past the 12 months, because in a lot of these cases, you had positive returns over the next 12 months, and then the other shoe fell and you lost a lot of capital. And so it's always important to look beyond this analysis and say, okay, great, over the next 12 months, I may have positive returns, but what about after that? My assumption right now is that we could possibly see positive returns in October, November, December, right? Get past the midterms. Maybe we get some gridlock in Washington, just something to stop the stupidity. And, that gives markets some relief here. And we get a nice little rally going through the end of the year. We got a lot of spending, holiday shopping, economic data picks up a bit. Atlanta Fed GDP right now, 2.3% for quarter 3. We talked about the first 2 quarters being negative. We likely have a bounce in quarter 3, seeing some better economic data here that's helping support that. So possibly we get this bit of a rally. And then in 2023, all these rate hikes and quantitative tightening, that's where the recession is. That's where the next leg of the bear market is. So, we could see this potential here for positive returns, and all the bulls are going to come out and go, "Aha, see, told you, right. Bear market's over, right? And you've got to be in." And then you're going to smack on the other side of this thing. So that's why we've got to be really careful not to fight the Fed, because the Fed is going to cause, I'm not going to say they're absolutely going to cause a recession, but they're going to cause a problem, and probably next year.
Yeah. And I'll even say, folks, I think they're causing a recession. And so something has to change for that assumption to change as well. All right. A couple quick things. So Sven also said that, he and I talked about, hey, how low could the market go? And we talked sort of from a fundamental level. And he agreed with a lot of relatively recent guests in this program that, sort of the correction we deserve is somewhere in the 40 to 50% range here, if you're trying to get it down with sort of like historical trend averages and stuff like that. He's not saying that that's exactly what's going to happen. Certainly could, but he is he's prepared for anything. But I think he is thinking it may be more likely that, at least for the next sort of 9-ish months or so, that we just see a lot of chop. Almost sort of like what you said, we saw in the 70s, maybe not so much with the Fed hiking, easing in the next 6 to 9 months, but who knows? But just a lot more volatility, a lot of sideways chop. And he loves that as a trader, because it gives him a lot more opportunities to take profits on the upside or the downside. I think for the average investor, that's probably pretty nauseating to go through that type of market. And obviously for you as a capital manager, you got to figure out what you're going to do there. And so I guess let me ask this: if we end up having just a lot of chop, what will your strategy be?
Two things to talk about, and we have to be a little bit cautious with these predictions of 50% drawdowns and those type of things. And I'm not saying that can't happen. I'm not saying that at all. We have to be careful with it because we have a different dynamic going on in the markets now than we've had at really any other period in the ever, right? And that is this exorbitant rise in the amount of money going into exchange traded funds. And we've talked about this on the show before. And this is worth recapping so that you understand, why we could have a seemingly bear market, but the market not go down 50%. And here's why. Out of every dollar that goes into the S&P, I just did this analysis a couple of weeks ago in one of our and actually it was in last week's newsletter on our website. So if you go to realinvestmentadvice.com, click on our newsletter link and look up last week's newsletter, there's a graph in there of the amount of money that goes into the top 10 stocks of the S&P 500. So for every dollar that gets invested into the SPY ETF, so the Spiders, S&P 500 ETF, and the symbol's SPY, most commonly probably traded ETF. Every dollar that goes into that ETF, 30 cents of that dollar go into the top 10 stocks in the index. What are those top 10 stocks? Apple, Google, Microsoft, Visa, MasterCard, NVIDIA. Those are the companies, right? And so all that money out of 30 cents of every dollar that gets invested into an S&P ETF goes into those top 10 stocks. Now there's 357 ETFs that all own Apple, right? So when people are buying, and Apple's one of the top holdings in all these ETFs. So every time somebody buys any of these ETFs, there's just a massive amount of money that's flowing into Apple shares. So if you, and you have to kind of think about this like an iceberg. So for every dollar that goes in, 30 cents goes to the top 10 stocks, 60 cents goes into 490 stocks, right? So they get very little money flow. And so if you're trying to, and this is one of the challenges being a fundamental investor right now, there's some great fundamental companies and you can go buy them and they don't go anywhere, right? Because they're not getting any money flows because they're either not in an ETF index or there's such a small weighting in that ETF index that gets no money flows. So the price just doesn't move. And then you're sitting going, why is Apple just going up every day? Why is Tesla just going up every day? It's because of all the money flows. So here's my point about this. And then this is important. There's just something to consider. If you're betting on this market going down 50%, not saying it couldn't happen, but in order for that to happen, what you've got to do is scare all these people that own ETFs and get them to start dumping ETFs. But, kind of going back to our iceberg analysis, if you look at an iceberg in the ocean, you see it floating around. That's just the tip, right? So that's the top 10 stocks in ETF. Below the surface is this massive chunk of ice. That's the bottom 490 stocks in the index. And if you look at those stocks, right, they're in a bear market, right? There's, hundreds and hundreds of stocks in the indexes right now that are down 40, 50, 60, 70%. They've had a major bear market in their shares, but the index is being held up by those top 10 stocks that haven't had that massive decline in market capitalization. So we've had a bear market this year. And if you could strip out those top 10 stocks, you would have a much worse performing index. But that's the illusion that's been created by this passive indexing wave that we're in. So my point about this is, and I'll conclude with this. My point about this is don't place a bet on the market going down 50% because you may be disappointed. The bet is are the stocks that you own, are they already in a bear market or are they about to be in one? And that's the real differentiator that you should be paying attention to.
Yeah, that's a really great point. When I interviewed Bill Fleckenstein last, which was a couple of months ago, he talked about exactly this, is how today's markets are different than what we've had in the past. And I can't remember the exact words he used, but in my mind, my memory was, this huge passive buying ETF, massive ETFs that we have now. It's this mindless juggernaut, right? It's this thing that just goes on autopilot, but it's massive. And so if you just get in front of its way, you're just going to get crushed because it's basically the biggest player in the markets these days.
Yeah.
So you're right. That player can continue doing what it's doing for a hell of a lot longer than you think it should be able to do it. And it doesn't matter how morally just your position is, as long as this juggernaut's rolling, it's gonna go where it wants to go.
Look, and it's really bad. I mean, look, it's a sad thing because when I grew up, I was taught to buy fundamentals. I was taught to look at cash flow statements and those type of things, and this passive indexing ETF thing has destroyed the markets in terms of price discovery, and of course, you can't leave out the Fed. And they're just as responsible for destroying price discovery. And this, we don't talk about, if you listen to the media lately, right? What is the media talking about? We're having this rally in the markets, and the conversations aren't, hey, the market's rallying because, earnings estimates are too low. They need to come up because we have a stronger economy, or, valuations, trailing valuations are cheap. That we're not talking about markets that way. The entire market was focused on one thing. Is the Fed going to pivot or not? When does the Fed become the market? That tells you right there that there's something wrong with the markets. And if you're trying to be this fundamental investor, you're likely going to have disappointing results because it's the technicals are driving the markets now. It's the Fed and technicals. That's about all there is.
Yeah. And you and I have ranted this, and I even just ranted it yesterday with Sven. We can't, in this market, you really can't be an investor because what drives market action is essentially Fed policy. And so instead, we all just have to speculate on what, 7 people around a table are going to decide to do next, right? Which is super frustrating for all the reasons you mentioned. Yeah. All right. So just to close out this point, so as long as there's net positive money flows into ETFs, the juggernaut should sort of continue doing what it's doing. I'm not going to say we are definitely, but if we get to a point where investors start net taking money out of ETFs, do you have the same thing in reverse? In other words, would we expect these top 10 stocks to take the brunt of the fall?
Yeah, I mean, that's what I was saying. That's the risk. What you got to have happen here is something has got to spook the markets, and people go, I'm out, and they go sell their spiders and their Excel, their basic materials ETFs and all that. And yes, it works exactly in reverse. Now you've got 30 cents of every dollar coming out of 10 stocks, and so you're going to see Apple down, playing catch up with the rest of the markets, and that's maybe the advantage of owning some of these smaller cap stocks, and I don't mean small caps, I'm talking about smaller capitalization stocks in the S&P, is that a lot of these stocks have already been beaten up. And if you do get this kind of bearish rotation in the markets and people do ultimately start selling their ETFs, those stocks, the ones that didn't really participate on the way up, well, they're not going to participate on the way out either. So you may actually wind up being much better off in some of these companies already beaten up, because Apple, Microsoft, Google, et cetera, those are going to get sold off sharply as, hedge fund. And look, and right now, we've talked about this before, is that everybody's hiding in those top 10 stocks because they're liquid. I can put money there. They don't track the market specifically, right? I mean, so Apple's held up a whole lot better this year than the rest of the market. So, that's where everybody's hiding capital for the moment. I've got to be invested because I'm a mutual fund or I'm a portfolio manager, whatever it is. So I've got to have some money invested. How do I do that with the least amount of risk? Well, I buy Apple, Microsoft, Google, Amazon, because that's where all the money flows are going. Well, if that reverses, those are going to get sold, and they're going to get sold off hard. And you're going to get the second leg of the bear market, theoretically. And you'll want to be in those smaller stocks, which will probably actually benefit from some money rotations.
All right. So I'm going to ask you to speculate here for a minute. Would the following spook the market enough to make that possible? Economic growth really craters, right? We go into a very clear, obvious recession. We see profit margins fall dramatically, and we start seeing companies laying off people like we've done in previous recessions. I'm talking, millions of lost jobs over time. And we start seeing real trouble in the credit markets.
Okay, so assuming that, what's the Fed doing?
Doesn't matter at this point.
No, it does, and it absolutely does. So your question is, and let me tell you why I'm cornering you on this. Your question is basically we have a credit market issue that leads to an economic downturn of substance, and we start experiencing kind of the early throes of a financial crisis. Okay, yes. Your point is well taken that would actually probably spook investors to start selling ETFs. Now, the reason I'm bringing the Fed into this is how long is the Fed going to wait before they pivot, drop rates back to zero, start doing QE? Because now, as soon as the Fed pivots, all those people that were buying ETFs are going to jump right back into buying ETFs again. Because
okay, and this is my question, and this is why I said maybe it doesn't matter initially, which is, so first off, the scenario I laid out, I'm not going to say is going to happen. I'm going to say it's looking like it could happen, right? Like there's definitely
no disagreement.
That seems to be the trajectory we're on here, right?
Right.
So if it does happen, and I think I might have mentioned this earlier, we talk about the lag effect of the Fed policy, right? So once the moment the Fed says, all right, well, we overdid it, we're switching course here, I'm announcing the PAL pivot this morning. It's going to take a long time before that whatever the Fed does manifests in the market, right? We're going to see continued downdraft from the continued arrival of the delayed impulses, right?
Right.
And I believe you're a greater student of history than I am, but I believe when we've seen Fed pivots in the past, certainly saw this, I think, in the 70s. The market continues downwards for some months, sometimes a quarter or two, once the Fed changes policy. It takes a while for the market even to rebound. Now, I know in today's markets, they tend to look at anything remotely positive and try to trade on that. But my question is what do you think would happen in this case? Could simply the Fed announcement of what it is going to do cause the reversal? Or if we really are entering the beginnings of a financial crisis, would the markets kind of need to flush out for a while?
It's a great question, and the true answer is that nobody really knows. But I mean, we can look back at 2020 as a good example of that. I mean, as soon as the Fed, dropped rates to zero and announced 120 billion a month in QE, that was the bottom. And that was because, now see, the difference is that in the 60s and 70s, we hadn't trained investors that every time the market hiccup a bit, that the Fed was going to come to the rescue. Now, and this is really, look, and let's go back, look here recently at July. At the July lows, everybody's convinced the world's coming to an end and we're in this massive bear market. And as soon as there was a hint the Fed might pivot, it was no longer the fear of missing out on the downside. It was the fear of missing out on the Fed pivot, right? And everybody started piling back into stocks. Oh, the Fed's going to pivot. Fed's going to pivot. We have trained, and again, we talked about Pavlov's dog experiment, on the show before. We have, the Fed has effectively been training investors for 12 years now that when they ring the bell, you better be buying stocks. And that's what I'm saying is that the speed of the turn now, when the economic crisis shows up, the Fed's going to go inflation. We got to fix the market, and they're going to be right back. I mean, it's going to go from QT to QE and zero interest rates literally overnight.
I think that's a good point, and hey, that very well could be what happens.
Yeah.
What I think is different from the 2020 analogy, and I appreciate you bringing it up, is there wasn't this backlog of restrictive Fed policy that would have continued to hit into the situation as the Fed was starting to really stimulate, right, or overstimulate. So it was a hey, we're beginning to shut down the economy, so let's just flood things in here, right? But they were starting from a point where the Fed was already super accommodative for the most part. Yeah. So it'll be curious because this time we'll have those big cross currents, right? Now, of course, if the Fed comes out and says, hey, look, we are releasing $100 trillion tomorrow. Well, yeah.
Well, you bring up a good point, but remember what drives markets is psychology, not actual impacts, right? So, even though you have this backlog of tighter monetary policy that will be impacting the economy, remember markets are going to shift on a psychology basis, and markets will start recovering even before the economy does. So, and again, this is why the Fed, that everybody's so attuned to what the Fed says more than what they're doing, because, the Fed was not saying, the whole Fed pivot thing in July and August, the Fed was not saying they were going to pivot. They weren't even alluding to that. They were sending speakers out going, "Hey, we're fighting inflation, people."
Right. The market just wasn't believing them. Yeah.
Yeah. And that's my point about psychology. So look, here's the bottom line. I have no idea what the market's going to do from one day to the next, much less, that point in time. But, all I'm saying is I think we have to be very aware, and especially in terms of managing our money, that, when the market shifts, it's going to shift very quickly, and it probably won't make any sense why the market's shifting, but the market will be sniffing out something, and they'll be sniffing it out ahead of what we actually see in the data.
Right.
So
right.
pay attention to the market.
God, I hesitate whether to even bring this up, but it occurred to me as you were talking. I'll just put it out there. Maybe it's for a future rant, but like, when the Fed steps in these days and tries to engineer a reversal in sentiment to try to get everybody back in the pool again, because it wants asset prices in a different place than where they are,
right,
it kind of begs the question then, like, well, then why even freaking have the market? Fed, just tell us what you want the prices to be. Right. Why don't you just tell us where you want the S&P to be, and you're going to put as much money in there to make it, make the market hit that, and we'll all trade on that, and we'll all get rich together, and
No, look, I mean, if you just watch Congress, right? So they're apparently in the know. So yeah, I mean,
or the Fed officials themselves in their own trading accounts, right?
Or better yet, why don't you just do this, right? I mean, why not just give, everybody's all worried about income inequality and stuff. Instead of sending out, spending trillions of dollars in the economy doing all this other nonsense, just send everybody $1 million in a trading account, and you don't get to actually touch it. But the Fed just says, okay, we want the wealth effect to be here, and then they just make that much money appear in your account. I mean, literally, that's what we're kind of getting to.
Well, and the sad part is there's demand for that too. I mean, not just top down. There's a lot of people that would love for that to happen, right?
Yeah, and just get rid of the markets. They're kind of a pain in the ass anyway. And my life would certainly be a lot easier because I would have to write all these articles all the time. So
yeah, well, and. Look, maybe we talk about this super briefly. I do want to get to the trades that you guys have made recently.
It's a long list.
So back in my previous life, we talked a lot about inflation, and we use this analogy of people in a lifeboat, right? Your ship sinks, you find yourself in a lifeboat with 2 other people, and you're rummaging around. It's maybe a couple of days at sea. You're all hungry, thirsty. And somebody all of a sudden, removes a board and finds an apple there, or an apple, right? So he's got the apple. He's going to eat it, right? You and the other guy reach in your pockets to see what you can offer, and one guy's got $1, you've got $2. All right, if the guy's actually willing to sell the apple, how much does the apple go for? Right, it goes for $2, right?
No, that's entirely wrong. It goes for the stronger guy who killed the weaker guy.
The guy with the oar who beats him over the head. Yeah,
exactly.
But assuming you're all still treating each other with a shred of human dignity, it sells for $2. Now let's say the other guy all of a sudden realizes in his back pocket he's got $100 bill, and he pulls it out. Right, now, how much does the apple go for? Right, goes for $100. Right, and the point is really all giving people free money like that all it does is just raises the price of everything to immediately compensate for it, right? So the wealth inequalities are really all still there, right? All you've done is just destroy the purchasing power of the currency, right? Which doesn't help anybody, right? So we all want that free money, but we don't really realize that all we're doing is hastening the end and not making ourselves any better in the process.
Well, look, we've talked about this. I wrote articles about this. There, right after the Biden administration did that last round of $1,400 checks, they said this is going to lift 50% of the people out of poverty. And I wrote an article that says, absolutely, it's going to lift 50% of the people that are in poverty out of poverty for exactly 1 year, and then they're going right back into poverty because again, if I get the big people have been talking about lately is like we need free childcare so people can go back to work. Right. Childcare costs so much and people can't afford to pay it, so they can't work. Well, if you're going to give people money for childcare, what do you think the childcare providers are going to do?
Yeah, they're going to
Right?
raise rents.
They're
Yeah.
going to raise their prices. And look, I mean, Ford is a great example of this, right? So we passed this Inflation Reduction Act that's going to extended the $7,500 tax credit for buying electric vehicles that only rich people can buy anyway. And then what did Ford do? They raised the price of their Ford Mustang Mach-E by $8,000. So, what was the point? And so, I mean, this is the way the economy works. And what is fascinating to me is how stupid our politicians are, right? I mean, and look, they're not really stupid. They know exactly what they're doing. If I give you something to do this stuff, you're going to vote for me.
Well, I think it's half of that and half of the other. I think
maybe.
They are pretty stupid, and they also know that part.
Yeah, it's about getting votes at the end of the day. But yeah, I mean, look, we're not doing anybody any favors for doing all this stuff. And again, if you let everybody hates capitalism now because we've screwed it up so much by through corporatism.
Right, we distorted it. We bastardized it.
Yeah. And if you just allow capitalism to work, it's going to suck for a couple of years as things rebalance. But guess what? Things will be a lot better when you get there. This same thing we talk about in the financial crisis. If you let the major banks fail, which you should have, it would have sucked for a couple of years. Man, it would have been bad, no doubt about it. But we would have a much better financial system.
The smaller middle banks would have stepped in. They would have done the job great over time.
Absolutely. And then you'd have a much fairer banking system across the board. You wouldn't have these megaliths, driving markets.
Okay, and this is actually where I kind of wanted to take this week's rant. But before we do, let me make good on asking you about trades that you guys may or may not have made over the past week.
We didn't make any trades this past week. Just kind of really been watching this market. Again, we're underweight equities. We're overweight cash. So it wasn't a whole lot to do here. And we like our positioning right now for our portfolio because we're kind of tilted more towards value and underweight growth right now. Week before, we added to some of our energy exposures. Energy stocks had gotten really beaten up, and the oil prices had been in a fairly defined downtrend and had bounced, and we're looking to break out of that downtrend a bit. So we bought we didn't really buy a bunch of energy. We just added a little bit to our current exposure to energy. We bought some additional shares of ExxonMobil and Devon Energy, which we like a lot, particularly because of the dividend yields in both those companies. The energy weighting in the S&P is about 3%, and we're currently carrying about 4% in our portfolio. So we're a little bit overweight in energy in terms of our allocation.
Okay. All right. And as you look forward in the week ahead, do you have any trades you're sort of planning on making, or are you just going to see how the chips fall?
Well, we're going to see how chips fall, but we're looking seriously at Johnson & Johnson right now. We like that company a lot. We're a little bit overweight healthcare, but healthcare's had a great run here. It's been doing well here just recently, really kind of outperforming the market. And we already own some other healthcare companies like AbbVie as well as UNH and CVS. And so we like those companies, and we kind of like that core base. And look, we can talk about the fundamental story of healthcare. Nobody's getting any older, or nobody's getting any younger. And we got a big, older contingent that's going, they're heading towards the healthcare. We talked about how much people are going to spend on their healthcare and retirement.
Right. So the silver tsunami.
Yeah, and I think there's a reason to be overweight healthcare as we go forward. We are a little bit underweight technology right now, so we're kind of digging around in that space at the moment. And what we're looking for there is if we do move into more of a disinflationary environment, which we expect later this year, and as we move into 2023, there's companies that have the ability to generate a lot of growth even in a slower economy, and so we'll probably look at adding to some of our tech shares that we have. And again, just recently, as a good example, NVIDIA, which creates, they build graphics cards and a whole variety of things for computers. They were hit really hard on Thursday. Stock was down about 11, 12% intraday on news that there was a restriction from the government on selling certain chips to China. And that would be about a $400 million hit to their revenue stream, which is about $7 billion. And the stock was down sharply on Friday, really much more than the impact of their earnings are going to be. And the stock's already been beaten up a good bit. So the stock's still a little bit expensive here. And we have a very, very small position in NVIDIA that we're starting to build into because we like the long-term view on NVIDIA and where it's going and its place. look, the generations coming up, they're going to be playing more video games, watching more stuff online. I mean, this is all, Bitcoin mining, all this stuff, it's not going away. And that's specifically the space that NVIDIA plays in. So we like the long-term story on that. And so as this stock continues to get cheaper, we're going to keep kind of building a position into it.
Okay, and that is the silver lining to bear markets. I know sometimes people will listen to these chats of ours, Lance, and think, God, you guys are just so bearish. It almost sounds like you're rooting, for the markets to get crushed, and we're not rooting for the human cost that's
right.
going to come along with a serious market correction, but we do feel that these markets have been overly distorted and deformed to the upside for far too long. There's a lot of malinvestment that results from that. There's a lot of unfairness, wealth inequality that results from that. So we would love to see that reduced. But on the individual level, if you're able to protect your wealth through the correction, then there's an opportunity to buy into really good long-term value companies at great prices. And that's, again, that's the silver lining here, right? That's really what we're trying to help people do. Indeed, if we are going through kind of a market storm ahead, is to make it through to the other side. So when the sun comes back out, they're in a good position to get into these great long-term companies at really attractive valuations. See you nodding here.
Well, no, and that's absolutely right, John. We have this, and it's the media's fault, right? I mean, it's all the financial media really, because we've put this really negative view on bear markets, like, oh my gosh, it's a bear market and you're going to lose everything. And that's not the way markets work. Yeah, markets go up. And then when markets are going up, we can't get enough of them. We got to get more and more and more and more. We got to try to generate all we can get when markets are going up. And, instead of treating markets as to what they are, if you treat the market like a casino, it's going to treat you like a casino, and it's going to take all your money, because that's what casinos do.
That's a great way to put it. Yeah.
Yeah. If you treat the market like what it is, which is a facility to grow your wealth at the rate of inflation over time. And now I'm not talking about just 1 year inflation rate. I'm talking about the long-term historical averages. If you treat it as a method to have your assets grow at the rate of the average rate of inflation over time, in other words, to protect your purchasing power parity 10 years, 20 years, 30 years from now, it will treat you well. And that means that when markets are rising, you're conservative, right? You invest enough to participate with the rise in the market, but you don't take on excess risk that leads to catastrophic losses when they occur. Last year we were overweight equities in our portfolios, and in January we got severely underweight equity back in January of this year, because we were concerned about where the dynamic of the market was going. And look, the market could have kept running, but we were willing to step off and capture those gains, because we had 3 years worth of gains locked up for our clients in 1 year. So if our clients need an average of 6%, I've got three, almost 4 years of gains in 1 year. I don't need to take a lot of risk. I can take my foot off the gas and then reevaluate things. And that turned out to be a good move. But the problem is that we don't treat markets for what they are. And by getting all wrapped up into this bull narrative or this bear narrative, you're missing the point, which is this bear markets. There's a lot of stocks, as I said earlier, there's a lot of companies that are down 60, 70, 80%. Some of them deserve to be down 60, 70, 80%. Peloton, others, right? There's a lot of companies here that aren't going away. And they're going to be here, after this is all over. And they're still generating lots of revenue, lots of sales. There's opportunity there. But again, you don't have to go in and buy everything today. You buy a little bit. If it gets cheaper, you buy a little bit more. If it gets cheaper, you buy a little bit more. And ultimately, you're going to have the bottom. And then when this thing comes out on the other side, guess what? You're making money. And that's the whole goal about this. We do two things that are most detrimental to our money. And I just had this conversation yesterday with a prospect. He's a great guy. And I hope he's not watching this video, because he'll know who I'm talking about. But we were talking about specifically, one of the biggest mistakes that we make is that we monitor our portfolio from January the 1st, December 31st every year. That has no bearing on anything, right? But we anchor to where we were on January 1st of this year. It's like, oh my gosh, my portfolio's down 12% this year, 15, whatever. Who cares? Where were you 2 years ago? Where were you 3 years ago versus today? Bet you're still positive. right? What's been your average rate of return over the last 2, 3, 4 years? Probably 4, 5, 6%, about where you should be. And if you would look at it in these terms, all of a sudden you pull all this stress out of your portfolio and you can look at, okay, I'm still hitting my benchmark. I wanted 5% a year. I'm at 6% average for the last 3 years. I'm gonna just look. I'm gonna sell all this stuff that's not working. I'm gonna buy some other stuff over here that's been doing well. Rebalance my portfolio. Don't get wrapped up to what it was, right? Because what it was on January the 1st has no relevance to anything, right?
Mm-hmm.
Look at it over a period of time. Get a better grasp of what your money is doing over time, and you'll start to make better decisions about your money going forward.
All that was super well said. I'm just going to add a comment onto this, which is how we should also take the same approach towards the economy, right? We have developed this allergy to recessions, right? But an economy is supposed to be just like the seasons, right? You have abundance, and economically, too much abundance creates malinvestment. So therefore you have the bust to clear out the dead wood, and then things go back. And that's a healthy cycle, right? But we have developed this zero tolerance for recession. And when we sniff one potentially on the way, we usually call to the Fed and say, please come make sure we don't ever have a recession, right? And it's, to kind of borrow your garden analogy, it's like a garden, whereas if you just demand that the garden produce at maximum output all the time without giving it a winter to lie fallow and to replenish the micronutrients in the soil, well, basically you just end up depleting the soil because you've just sucked everything out of it, and eventually your great harvest, turns into a great famine. So
that's right.
Yeah. So, anyways, we're pre-ranting here, which is good.
Yeah, no. And look, I've used the analogy of California wildfires before, right?
Right.
Because it's the same thing. And poor land management leads to more fires. And so you need a recession. And we should be happy to have a recession, right? Look, I know recessions, people lose their job. I know nobody wants to lose their job. But guess what? If we would allow recessions to occur on a more regular basis, you wouldn't have the severity of job losses. They wouldn't be as deep.
By delaying them, you make the inevitable one way more damaging. Yeah,
exactly. And that's all. And again, you build up these massive excesses that lead to more corrosive environments like a financial crisis. And that's, this is just, again, the interesting thing about the people that run our government and our economy. We've got these few people in charge that are making these decisions for a population of 330 million people. It's like, come on, man, just, let the economy do its job and everybody will be better off.
All right. Well, amen, brother. All right. Well, look, let me get to the rant real quick, and then I have a few positive things as we wrap up here. No, this was kind of the warm up stretch. All right. So we were talking earlier about the distortions that happen when the government intervenes to help, right? And then all they really end up doing is just driving prices higher and making the system more unstable. You and I kind of pre-ranted about this a month or two ago that it might happen, and then we just got the announcement a little over a week ago that there's going to be substantial student loan forgiveness.
Yeah.
Right. And look, if the government's going to give money out, I'd rather have them give it to Main Street than to Wall Street, right? So let me put that on the table. That said, I'm pretty much almost in all cases against bailouts. And what I think is really dangerous about this one is it doesn't address the root cause at all, which has been the government takeover of the student lending industry. And that basically has let colleges raise tuition as high as people can possibly borrow, right? So it's created this complete perverse incentive that has sent college tuition to the moon. It's one of the fastest appreciating costs over the past couple of decades, and that's why, right? So it doesn't address that at all. It is, it rewards moral hazard, right? So the people that kind of did the right thing, which they worked hard to pay off their loans, or many people forewent to college because they said, hey, it's too expensive. You're rewarding people that haven't paid off their loans. And I get the humanitarian side, which is, hey, these are the people that need help the most. But you're basically breaking the social contract, right? You're telling people, you know what, don't do the right thing that we tell you to do. Actually, go do the more reckless thing. And I'm not trying to paint all people with college student loan debt as reckless people, but there certainly have been some out there. And those are the folks that are getting rewarded here. The other thing that I think is really corrosive about this is, as a public, as a populace, we have been united to date in our justified anger in the previous bailouts that have happened. Those banks are getting bailed out. These bankers that caused the crisis, we're all angry about that. Or, hey, they're giving the rich tax cuts. Oh, we're all angry about that. This one actually really begins to divide the populace, right? Where all of a sudden you're like, hey, wait a minute. Why is that guy getting bailed out and not me, right? Like, I had to pay for college and you're giving it to him, but where's my cut, right? And so it begins to turn kind of neighbor against neighbor here. And I think that lays the seeds for something potentially very corrosive. So anyways, I'll pause here for a moment and let you jump in, Lance, because I know you've got some pretty strong thoughts here.
Well, a couple of things. First of all, my mortgage, it identifies as a student loan. So, where's my bailout?
Yeah, I've heard that joke. Yeah.
But it's a fair joke. All right. I mean, why, what about, as you brought up, I have a lot of my friends that went to college, they paid off their student loans and, they're not getting anything back, right? They honored their contract. But here's the interesting thing. First of all, the president has no constitutional authority to forgive student loan debt.
Right. And sorry to interrupt, but I should say this does have to get tested in the courts, or likely will, right? This isn't a guaranteed action at the moment.
Yeah.
Correct?
Yeah. We'll see what happens. And, post midterms, I mean, you might see this whole thing get shut down. If theoretically, if Republicans regain control of the House and the Senate, they could shoot this down pretty quick. We'll see what happens. I'm not making any claims that I know, but look, Congress controls the power of the purse, and the government, the president, has no authority to just, forgive student loan debt or any debt to that degree because of the constitutionality and, contract law. So there's a lot of problems with this, and we'll have to see how this all gets worked out. Not a lot of pushback because everybody wants free money, but that's
right.
That's near here or there. But the other problem with this is it's a very slippery slope. There was a recent piece of research out that says at the end of the day, this is going to cost like $1 trillion. And, because of all the ancillary knockoff effects that are going to occur from, forgiving student loan debt. And again, this is always the case, right? We thought giving checks to households would be, that'd be a great idea. And then nobody ever thought about inflation, right? It's always the unintended consequences of these things. And so if you thought student loan debt was high now, right? Or sorry, if you thought college tuition, that's what I meant to say. If you thought college tuition was high now, wait until you start forgiving student loan debt. And I've said this before, is like, if you're going to forgive student loan debt, you need to do it. The only way you can do this is to end the student loan program. You say, look, if you're in the student loan program right now, this is the last loan we're giving out. Nobody else can get a student loan, and we're going to forgive everybody who has debt. Because if you keep giving student loans out, then you've got to start forgiving their debt, right? Because they're now going to expect that if they take out a student loan, their debt's going to get forgiven. Okay, so
right.
By extension, if the colleges are going, hey, wait a second, now the government's going to forgive student loan, guess what we're doing with our tuition? Right? Because why not? I mean, if you just borrow more and the government's going to forgive it, then you're going to borrow some more and the government's going to forgive it. I mean, this is that unintended problem that's going to get created down the road. And this is a very bad idea. But, lastly, the thing to say about this is that, when you start, doing this type of stuff, and look, everybody has the best of intentions, right? Okay, let me give you a good example. Best of intentions. Bank of America just announced on Thursday that they're going to start giving out 0 interest mortgages to minorities for first-time home buyers. Now, that sounds great, right? Heart's in the right place. We can help minorities that can't afford a home by giving them a 0% mortgage. Now, listen to what I just said. We're going to help minorities that can't afford to buy a home with a 0% mortgage. And that's awesome. They can't afford the home.
They can't afford the home. Exactly. We're putting them in a trap. We're putting a nice bow around it, but yeah.
So great. Yeah. I can get into the house with a 0% mortgage. That's awesome. Now I'm trapped into this mortgage payment. That's great. what about all the expenses that come along with that house? There was a great survey out just recently, I believe is either Statista or Wall Street Journal, I'm not sure which one, but they had a survey of all these millennials that ran out and used their money that they got from the government to buy a house. And 26% of millennial home buyers are like, I totally regret that decision.
Have buyer's regret. Yeah.
Yeah. Because nobody told, there's a guy on you. I know I'm jumping around. I'm going to get back to college tuition here in a second, but there's a guy on YouTube, and he makes all these videos about things your dad should have taught you. Stupid things, right? You say stupid because if you had a dad growing up, you probably learned this stuff. But a lot of people grew up with dads that couldn't do things like jump start a car or shave or fix a lawnmower, these type of very basic things that I learned from my dad, how to change a tire, right? Things that we were taught by our parents. There's a whole generation of people that are coming up that don't know how to drive a stick shift car. They don't know how to change a tire. All they know is to take the car to Jiffy Lube to get the oil changed, right? And so this guy's like 20 million viewers, right? Teaching people how to do basic things. Well, what nobody taught these kids that were running out buying homes is all the costs that go along with buying a home. It's not just the mortgage payment. It's the taxes,
insurance,
it's the utilities, it's the maintenance, it's all that. And, so great. We're going to here we are. We want to help the minority community, completely fine. No problem with that. Strapping them into a home they can't afford is not helping them. It's going to make the problem worse. And this is the same thing with student loan debt, right? The only people we're helping out with student loan payoff is the higher income earners who have more of the debt than others. And they're the ones that are going to get a big bulk of the debt relief. And it's only going to cover their interest payments that they're behind on, because we also threw the moratorium on all the student loan payments. And they didn't have to make student loan payments for the last 2 years. That's awesome. We pushed that through to December. The interest has
accrued. Yeah.
Right. So this $10,000 isn't even going to cover the interest for a lot of these student loans are getting paid off. So they're not in any better position than they were going into the financial into the COVID crisis.
You make some great points there. So, one is that there is a lot of, I think, very valid frustration, especially with people that sort of went into the trades saying, hey, nobody helped me out. And I've actually got to pay for these richer kids, to forgive their stuff, right? So there's a lot of justified sort of class anger that is kind of the corrosive element that I was talking about. And also the sort of ease of getting these loans to go to college, right? A lot of that was done under the guise, like you said earlier, about that minority homeowner campaign of, hey, we want these people that haven't been able to afford a college to be able to go to college and get a college education. So we're going to give them the loans to go do this. We're going to give them favorable terms. And in many cases, these kids get out and now they're just saddled with these crazy college debts, right? And so in many ways, they are much worse off for this quote unquote generosity than if they had just said, you know what, college is too expensive. Let me go into a trade.
Well, no, and we did them two disservices, right? We gave them this money. We said, oh, you have to go to college, right? We told them that.
Right.
And here's your money to do it. But we didn't tell them that they had to get a good degree, right?
Right.
And, if you get a degree that can't earn you an income, and a lot of kids are coming out of college with these, I don't want to call them worthless degrees. No degree is worthless, right? But, there are certain degrees that companies need and they're willing to
have
pay
low
for.
market value.
And there's other degrees that have low market value. And a lot of these kids are coming out. So go, hey, here's my piece of paper. I graduated from, whatever. And they're like, okay, great. I'm glad you got a degree. I've got 50 other people that have degrees that are degrees I need. Right. And, this is the thing that we didn't teach our kids about going to college. When my kids were going to college, we sat down and I said, here's the degrees that companies are hiring for. And here's all the degrees they're not hiring for. Now, if you pick one over here in the bucket of degrees that they're not hiring for, you're not going to get paid very much. If you get a degree out of these over here, you're going to get paid a lot more because they're in demand and this is what companies need. And we had that conversation. Now, what they ultimately wind up picking and choosing, that's on them. but at least there are
At least their eyes were
information.
opened.
Yeah.
Yeah,
And I
exactly.
don't, and I think we do a disservice to a lot of our kids of just saying, hey, go to college and just get a degree. It doesn't matter what you get it in. It's just fine. As long as you have a piece of paper, that's all that matters. No, it matters. It matters a lot.
Matters a lot. All right. Well, look, I'm going to start to slowly land the plane here. Given that we tend to generally end on rants, I want to try to introduce the practice of us. We still rant, but we'll try to end on something a little positive. And I'm going to take something that you, I think, legitimately, validly criticized, but make a positive out of it, which is Peloton, which is my wife and I, we have an anniversary coming up, and we talked about, okay, so what do we want to do for it? And we really decided that rather than just sort of spend money on one another to just sort of mark an occasion, that we wanted to have a more intelligent return on, our celebration of our marriage. And so we ended up deciding to get a Peloton for our garage gym, and just decided, hey, we're going to get a lot more use out of that, right? Rather than just a weekend getaway somewhere. It's something we'll appreciate every day, and it's going to be a part of our long-term, fitness and health. And our biggest thing that we want for each other is more time together in life, being, more years together of good quality where we're still active and whatnot. So yeah. I felt really good about that investment. We actually got it probably like a little over 2.5 weeks ago now. And man, I mean, we have used it every day. It's already kind of at the stage of like, how do we even get by without one of these? Because we're kind of fitness people. Not making the case for Peloton, but just saying this is a good mindset, I think, for life investments to make.
Yeah, no, absolutely. I think, my wife and I work out together, when we can, and, it's good time that we spend together. We talk or fight or whatever while we're working out. So, but it's time that we get to spend together. And I think it's great. My comments about Peloton in general are about the valuation of the company.
I'm right there with you. Like I said, I get it.
So I don't want people to think I'm anti-Peloton, because I think it's a really cool thing. For most people, they buy a bike and it becomes a coat rack, because they use it initially for a couple of days. Treadmills are the same way. You can go online right now and you can buy treadmills like brand new, never been used.
They'll like pay you to pick it up.
Yeah, exactly. Just come get the damn thing out of my house. So that's the thing about that. But yeah, just when I was talking about stocks being down 70-80%, deservedly so, is just bikes are great, but you can't build a business where it's going to generate that much revenue to support the market cap that Peloton had. It was just a flawed model.
Yeah, and that was a classic. Everybody was buying one during the during the lockdowns, and so the mania took over from this, the stock buyers standpoint. So yeah, totally agree that the big difference between the valuation of the stock and the value that at least I'm getting right now as a user of the product. And look, folks, not everybody can buy a Peloton. And it's great, all the programming that's out there for these things. Like it's different from the old days of just an exercise bike. There's great classes that actually really help you get the most out of the bike. But you could use a standard exercise bike, one that you pick up for cheap, and just get an old iPad and a good app and get 80% of the same experience.
You could also just get a bike and ride down the street. So you could.
You could. We live out in the country where there is some great bike riding, but it's also, there are no shoulders. So, I've done enough cycling.
That just adds to the excitement, right?
Well, and I've done enough cycling to have known and lost a couple of people through accidents like that. So anyways, not trying to push everybody on an exercise bike, but I just think it's a good mentality of like, find things like that where you're going to get a lot of life enjoyment. And you may actually, we I'm sure spent a lot less money than if we had hopped on a plane to go somewhere, for a nice long weekend to celebrate this. So anyways, hopefully folks take some good inspiration from that. Real quick, very important point to note for folks here. The Wealthion Fall Conference is coming up later this month on Saturday, September 24th. The early bird discount that gives you almost a 30% off discount to that expires tonight, midnight tonight on Saturday. So if you're watching this and you have not yet registered for the conference, right now, go to wealthion.com/conference and go sign up for that. You can still register for it over the next couple of weeks, but you're not going to get that early bird discount. So I want to make sure that everybody who's thinking of going gets the chance to get that discount. And as a reminder, if you go to that URL, you'll see all the details for the conference, but a great lineup of guest speakers, folks like former Federal Reserve senior economist Lacey Hunt, Lynn Alden, Lance is going to be there as well all day long. We're going to have Matt Taibbi, of award-winning journalist, Rolling Stone fame, the guy who coined the term vampire squid, related to Goldman Sachs during the financial crisis. We'll have Grant Williams and Stephanie Pomboy. We'll have Alf Peccatiello talking about the bond market. We'll have Doomberg talking about energy. We'll have Nick Jurley giving the latest on what's happening in housing, and a lot is happening there right now. We'll have Rick Rule talking about hard assets, Mike Maloney talking about precious metals, Jeff Clark talking about mining stocks. We'll have the guys from New Harbor there. There's going to be a lot of interactive Q&A throughout the day. It's definitely going to be our best seminar ever yet. So make sure you go to wealthion.com/conference and register today. All right, folks. Well, look, if you enjoy these weekly market recaps with Lance, do us a favor, help support this channel by first liking this video, but then hit the red subscribe button below if you haven't already, as well as that little bell icon right next to it. Lance, it's always a pleasure, buddy. I'll let you have the last word for this week.
Look, just sit tight here. I think we've got, some more work to do in this market. Certainly a retest of lows isn't out of the question, but, I think we can get a little bit of a rally in the next week or so. So use rally again, just continue to use rallies to sell into, raise some cash, reduce some risk, and we'll update you again next week.
All right, Lance, always a pleasure to do these with you, buddy. Everybody else, thanks so much for watching. And remember, given its expiration tonight, don't delay. Go right now to wealthion.com/conference and secure your early bird discount. All right, everybody, take care.